Should you pay off your debt, or should you be investing for the future? This is one of the biggest questions in all of personal finance. And honestly, the answer you pick can literally change your life. So today, we're going to break down exactly how to make the right call for you. So what is the right move? Do you throw every single spare dollar you have at your loans, or do you start building your wealth in the market? Well, the truth is, there isn't some magic answer that fits everybody. But I promise by the end of this, you are going to have a super clear framework to make the best possible decision for your own financial life. At its heart, this is a classic financial tug of war, right? On one side, you've got debt, and man, it can feel like this heavy weight just holding you back. And on the other side, you've got investing, this powerful engine for building long-term wealth. The real key is figuring out how to make them work together.
Now, if you've ever looked for advice on this, you know you'll find two very, very different philosophies, and each one has its own passionate supporters. So let's break down both sides of this argument and see which one really clicks with you.
Okay, so on one side, you have what I'll call the debt-free camp. They are all about guaranteed wins. And on the other side, you've got the growth camp, and they're focused on long-term potential. Let's see how these two really stack up. The payoff debt first folks use pure focus and momentum. You've probably heard of methods like the debt snowball, where you pay off your smallest debts first just to get those quick psychological wins. Or the debt avalanche, which is all about hitting the highest interest debt first to save the most money. Now, the invest while paying camp, they're playing the numbers game. They're basically betting that their investment returns are going to grow faster than their loan interest over the long haul. Okay, so if we just strip away all the emotion for a second, and we just look at the pure, cold, hard numbers, the decision really boils down to this one simple rule. It's a straight-up comparison. What's the cost of your debt versus what could you potentially earn from your investments? And this right here brilliantly illustrates why. I mean, think about it. Paying off a credit card that's charging you 20% interest is exactly like earning a guaranteed, totally risk-free 20% return on your money. There is nowhere in the investment world you can find that kind of guarantee. So from a purely mathematical standpoint, attacking high-interest debt is just an unbeatable investment. All right, so let's build a practical framework that you can use right away. Theory is great, but seeing the real-world numbers is what makes the decision crystal clear. Just look at this comparison. The average credit card interest rate is sitting at around 22%. Meanwhile, a pretty generous long-term average for the stock market might be about 8%. The math here is not subtle. That 22% debt is a financial emergency. Every single dollar you put towards it is giving you a massive guaranteed return. But let's flip the script for a second. What if you have a student loan at, say, 4.5%? Well, suddenly that 8 to 10% potential market return starts to look a whole lot more attractive, doesn't it? In this scenario, the math suggests that by just making minimum payments on that loan and investing the difference, your money could actually grow way faster in the market. So here it is, your decision-making cheat sheet. I want you to think of this like a traffic light. Any debt over 7%, that's a red light. Stop what you're doing, prioritize paying that off. Debt under 5%, that's a green light, a situation where investing becomes a really strong option. But then there's that yellow light, the emotional factor. Because let's be real, with money, it is never just about the math. And this is so, so important. For some people, the stress, the anxiety of just having any debt at all is this huge burden. The freedom and the peace of mind that comes from being completely debt-free, well, that's a return you can't measure on a spreadsheet. But believe me, it has very real value. And this is exactly why a hybrid approach is so popular. It really aims to give you the best of both worlds. You get that guaranteed mathematical win by absolutely destroying your high-interest debt first. Then, once that's gone, you pivot. You shift your focus to wealth building and investing, all while you comfortably manage any of that low-interest debt that's still hanging around. So, where do you even start? Before you just charge ahead with any strategy, there are a few foundational steps that pretty much everyone should take. You got to set yourself up for success first. Okay, this is your action plan. Step 1 is absolutely non-negotiable. Build a small emergency fund. This is your safety net. This is what prevents a flat tire or some unexpected bill from derailing your entire plan and forcing you right back into more debt. Then you've got to get organized. You can't make a plan if you don't know exactly what you're dealing with. So list out every single debt and its interest rate. And here are a few more tips to really accelerate your progress. When you get a windfall, like a bonus or a tax refund, use it as a powerful weapon against your highest interest debt. Automate everything, your payments, your investments, just set it and forget it to build that consistency. And finally, track your net worth. It's the best way to see the big picture, to actually watch your debt shrink as your assets grow. And that brings us to the most important part of all, forging a plan that is tailored specifically for you. It has to work for your numbers, and just as importantly, it has to work for your personality. And that is the real takeaway here. Look, the perfect choice on a spreadsheet isn't the right choice if it's going to cause you to lose sleep at night. The absolute best strategy is always the one that balances the math in your head with the peace in your heart. Ultimately, a good plan that you actually follow is infinitely better than some perfect plan that you give up on after a month. So take a moment, look at your own situation using this framework, and decide, what's the strategy that you know you will actually stick with for the long run? That's your answer.